Hi, I'm Sumera Abdi, and with me is Gaurav Mehta, Chief Investment Officer, Equity of SBI Alternatives Business. I hope you're having a good start to the year because the market certainly is. Well, it's been some time since we've spoken about SBI Optimal Equity AIF, and we are here to answer any sort of questions or concerns that you might have in your mind. We'll also talk about, where the fund looks to be headed. So, Gaurav, thanks very much for joining in. The first thing I want to talk about is that, in this long short space, there has been a lot of action, right? Once the indexation benefits went away, people looking to invest in debt funds or HNIs have been looking for alternative options with minimal volatility. So how does this fund fit into that space?
Right, so that's a good question. The long short category is a very diverse category. There are funds that aim to deliver debt-like returns, the kinds that you mentioned, 7-8% return in the hands of the investors. And then, there are kinds which are more equity-like, right? I think our fund is more on the equity-like category. So our endeavor overall on this fund is to move equity between 0 and 130%, with an average equity allocation of close to 65 to 70%. So to that extent, this fund is very equity-like in terms of its overall allocations. But at the same time, because we are using our asset allocation framework to move that equity allocation from 0 to 130, we are also very much focused on the downside. So over a cycle, our endeavor from this fund is to generate Nifty-like returns. But whenever there are big drawdowns in the markets, our attempt is to fall less than the indexes fall. So in that sense, you are trying to not compromise too much on returns, because at 6-7% returns, you eventually end up just meeting inflation, right? And over long periods, inflation has been around that number. So our endeavor still is to generate double-digit returns, something that Nifty does over a long period of time. But at the same time, whenever there are big falls, we also want to curb the downside volatility to the extent possible. So in that sense, this is not a debt-like strategy. This is more a equity-like strategy with an inbuilt cushion on downside protection.
All right, so it gives equity-like returns, but debt-like comfort?
I won't say debt-like comfort, but as I said, right, the endeavor is to cut risk to
so
half of the
maybe
index's
not
risk.
full equity-like discomfort.
Yes, that's
okay.
right.
So you explained, right, that the equity portion can go all the way down to zero. And also in times of big drawdowns, the fund will not fall as much as the market per se. But can you explain in practicality how this fund might have performed, say, in like the 2020 COVID crash?
Right. So I think I'll take you back to the asset allocation framework first, because understanding that is important, because it's that framework that is being used to calibrate this allocation between 0 and 130. And we look at overall market valuations, equity market sentiment, and earnings. But of the first two, on valuations, we tend to look at equity yields versus bond yields. And there again, we look at two measures. One is trailing earnings, and how is that earnings yield panning out versus bond yields on a relative basis. And then to take care of any cyclicality in corporate earnings, we also tend to look at a cyclically adjusted earnings number. And again, subtract bond yields from that earnings yield to get some sense of where equities are. So both valuation measures tend to focus on equity yields relative to bond yields. And the second aspect is market sentiment. And again, market sentiment works as a contrarian measure. We've tried to quantify this measure into one. Whenever the readings are too low, suggesting a lot of pessimism in the market, we tend to go overweight on equities as a contrarian. And similarly, whenever the readings are too high, suggesting a lot of euphoria in the market, we tend to cut down on equity allocations. So both valuations and market sentiment work in a counter-cyclical fashion. Now, in a period like COVID, the fund didn't exist then, but the asset allocation framework did. And what practically happened was this, that on the other side of that fall, obviously during that fall, you were much lower on equity allocations. So you were able to protect much better on the way down. But on the other side of that fall, valuations became very interesting, because equity yields almost equaled bond yields after the correction. So which meant that valuations were significantly in favor of equities. And market sentiment also became very pessimistic. And this combination of attractive valuations and market sentiment being extremely pessimistic meant, and again, earnings at that point were near a trough as well. So this combination meant that the asset allocation framework on this fund would have asked you to go to 130% equity allocation, which is the maximum possible. And then the reverse will happen in other extremes where you have peak sentiment, peak valuations, and peak earnings. At that point, the model will ask you to go to 0% allocation. But when this move from 0 to 130 is happening, your core equity allocation is not being touched. So the 65-70% of this portfolio is into core long-term equities. This is not being touched. The allocation, so let's say if you want to express 0% allocation, you keep the 65-70 equity untouched, you short Nifty derivatives to the extent of 65-70 and come down to net zero allocation. Similarly, when you want to go up to 130, again that 65-70 stock allocation stays, and then you long Nifty derivatives to the extent of 65-70, and that's how you go all the way up to 130. So in a way, we think of this product as two separate engines working together. One is the stock selection piece, and on top of it is the asset allocation piece being expressed largely through Nifty derivatives. And this combination we think should improve the long-term risk reward for investors.
All right, so it's two layers which is simultaneously working together to create this optimum, return, so to say. But Gaurav, with this fund, the returns have been a little bit lumpy. Now, investors are looking for low volatility, yes, but they're also looking for equity-like returns, right? So there are times when the fund has done very well. There are times when the fund hasn't done well. So therefore, what is an ideal time horizon for an investor to remain invested in this fund to get the optimum benefits?
All right. So I think firstly, this is all said and done conservative product. And to that extent, this is not a PMS kind strategy where you're always aspiring to generate an alpha over the index. And as you rightly said, over a cycle, you're aspiring to make Nifty-like returns. That said, over the last 18 plus months that the fund has been live, because valuations have been a little bit on the expensive side, you've always stayed either closer to that 65-70% neutral allocation or even lower than that. I think on an average basis, we would have been at 60% or a little lower than that in terms of the net equity allocation. So to that extent, we have never gotten the opportunity to either go down to 0 or 130. Those are the extremes where the product actually comes into its own. So it's been a suboptimal kind of a setting, in spite of which, if you look at the last 12 odd months, we've been able to do better than the index, and which is largely because the stock selection piece has worked, because the allocations are much lower than 100%, but because of the stock selection piece, you've still been able to do better than the Nifty. The returns are lumpy, yes, but that's only on a relative basis. If you look at the absolute returns, they've been very consistent, and obviously on the way up, they've gone to decently high numbers as well. But on the way down, we haven't had that many periods of big drawdowns in the overall fund. In fact, since the inception of the fund, which is over the last 18 odd months, the maximum drop that you've seen in the portfolio value is 3.7%. So to that extent, the objective of falling less than half of the index's return and being much less volatile than the index is being met. And the good news is that in spite of which, on the upside, you've been able to deliver decent returns.
All right, and that's all one can expect from their fund manager, right? Gaurav, thank you very much for joining in. Speak to you soon.